In 2023, a major bank failed in 48 hours. Everyone could see the problem in real time. The corner of the market worth watching today has the opposite feature. Its problems, if they exist, only get priced when someone chooses to price them. Welcome to G Theory. I'm Girish Navare, one of the founders of Eagle Harbor Advisors. Today we're talking about private credit and why the next problem in the markets almost never looks like the last one. Let's start with what happened last time. Before Silicon Valley Bank collapsed, its wound was visible to anyone who looked. The bank held bonds that traded every single day, and every rate hike marked them a little further underwater. Depositors did the math, and they ran. That crisis moved at the speed of a stock ticker. The area drawing scrutiny from independent researchers today works the other way around. It's the fast-growing world of private credit. In simpler terms, private credit means investment funds that lend money directly to businesses outside the banking system. Here's the key difference. Those loans don't trade. Their stated values change only when the fund manager's model says they should. And that one difference shapes both the risk and the way that risk would arrive. Private credit has grown into a multi-trillion-dollar asset class. Investors love it for two reasons: steady yields and remarkably smooth reported returns. But that smoothness deserves a closer look. When a loan never trades, its price doesn't fall on bad news. It simply isn't updated. Think of it like a house you never put on the market. You can tell yourself it's worth whatever you want right up until someone actually makes an offer. Meanwhile, according to recent research commentary, several quiet stress signals have been building. The first is what's politely called payment in kind. A rising share of borrowers are paying their interest not in cash, but in IOUs that get added to their loan balance. In simpler terms, the lender reports the income, but no money actually shows up. A borrower who can't pay cash today is betting on a better tomorrow. The second signal: funds have increasingly borrowed against their own portfolios in order to return cash to investors, rather than selling assets to raise it. That's a way to keep everyone happy without ever testing what the loans are really worth. And the third signal is the most telling. There are publicly traded vehicles that hold the same kinds of loans. They're the one version of this market with a live price, and they have persistently traded meaningfully below the stated value of their holdings. So you have two prices for the same kind of asset. The model says one thing, the market says another. When the marked price and the market price disagree, history tends to side with the market. Now, here's what this is not. It's not a prediction of a crisis. The research itself stresses that if strain arrives, it would likely come as a slow repricing, not a weekend bank run. A leak, not a burst pipe. That said, banks aren't fully insulated either because they've lent substantially to these very funds. So what does this mean for you? I think there are three durable lessons. First, smooth returns are not the same as safe returns. Sometimes smoothness just means nobody has checked the price lately. Second, know what you own. Private credit is increasingly being packaged into products marketed to individual investors. Anything that offers above market yield with below market volatility deserves one question: what am I not seeing? That so-called illiquidity premium can turn out to be risk that simply hasn't been marked yet. Third, pay attention to timing. Historically, the moment an exclusive institutional strategy is eagerly offered to everyday savers is a late chapter in the story, not an early one. Here's where the asset shield approach stands today. We remain at full sail. Equity participation is broad and healthy, and the evidence we track doesn't call for trimming. But credit conditions are squarely on the watch list. A genuine credit repricing is exactly the kind of broadening deterioration that our reduced sale rules are built to catch. That's the whole point of a rules-based framework. We don't have to guess when to get cautious. We let the evidence tell us. The last crisis was priced by the minute, and most people still missed it. The lesson isn't to fear what's visible. It's to be properly curious about what isn't. If you're a business owner or a retiree and you'd like to know how the Asset Shield approach would apply to your own portfolio, visit eagleharboradvisors.com. I'm G, plan, protect, prosper, and I'll see you on the next one.